So another ratio that investors are very often concerned is called the dividend cover ratio. Now, dividends, as we know, vary with the level of profits. Sometimes we might have low profits, which means that low dividends will be passed on. Sometimes the profits might be high, and we can expect a higher dividend to be paid out. So, since dividends are dependent on profits, investors are often concerned as to the ability of a company to maintain or sustain the current level of dividends they are paying. So usually markets react like this. If they expect that dividend has been increased, that shows a positive signal to the market. But if the market sees the dividend being reduced compared to the last year, that sends a negative signal to the market. So what this ratio does is dividend cover. It gives an indication by comparing the profit that was available to the company and the ordinary dividend amount declared from it. This gives an idea to the shareholder that whether the ordinary dividend that has been paid right now, will that be sustained in the future by the company, or the shareholder can expect this dividend to decrease in the future, which is something that shareholders very much dislike. Let me explain this with an example. So let's say there is a company that just made a profit of $100,000 for this year, and they have decided to pay $20,000 in the form of dividend paid and proposed to the shareholders this year. Now this means that your dividend cover will be 100,000 divided by 20,000, that's 5 times. So your dividend cover over here becomes 5 times. Now a 5 times is generally a high dividend cover. So a high dividend cover is favorable since this implies that the company will be able to sustain this level of dividend even if we can expect a decline in the profit sometime in the future. This is also an indication that directors are operating a conservative approach to dividend payments. They are very conservative about the dividend payments, and they are ensuring that they will be able to sustain this dividend sometime in the future, and majority of the earnings are being reinvested. As we can see from 100,000, if they've only paid 20,000 as dividend, the rest 80%, 80,000 becomes the reinvestment they're making into the business. Now, if the company had a low dividend cover and this number was somewhere around 1 or 2, that would mean that the company is following a reckless dividend policy, and if there is a decline in profits sometime in the future, we can expect dividends to be reduced. There can be a dividend cut which will send a negative signal to the market. Right? So just think of it like this. If the company had paid from 100,000, let's say 60,000, then we can expect that the company might not be able to pay out 60,000 every year if this number declines sometime in the future. But 20,000 is a dividend that the company can sustain even if your profits decline. Therefore, a high dividend cover is considered favorable for the shareholder because they can expect their dividends to be maintained, and a low dividend cover will be a cause of concern since you can expect the dividends to decrease due to any change in external circumstances or even the firm profitability.